So I'm going to get started. We do have an online audience, and we're inviting them to text in their questions, which I think will be received here. I encourage interaction. The best part of this is you with your questions. So for our online audience, there'll be contact information for after the event. You can call me directly, one of my partners, or email me directly. And for those of you here, questions are helpful. Okay? Let me ask, has anybody invested in notes before? Either of you a couple times? You're just
only through my own transaction.
where you've acted as the funder yourself? Okay. Okay, good to know. Well, my name is Adam Child. I'm the president of Titan Capital Holdings, and I'm here to talk to you about buying our notes that we have available, and they're both partials and whole notes, and I'll walk you through exactly what that is through the course of the presentation today. Note buying sponsored by Titan Capital Holdings. The agenda of the PowerPoint presentation will be who are we, the note basics, why buy notes, understanding note buying, sources of notes, leveraging your self-directed IRA, a very important vehicle that many people don't know about that you can invest in performing or non-performing notes with, what to look for in a note, and what the risks are. Rosemary, you were already asking this. Who are we? Titan Capital Holdings was established in 2009 to provide hard money loans to investors. Our original company here, started by Rick Rickert, is Infoclosure.com. That's a service company that helps investors pick up properties at auction. That company was started 15 years ago. In 2009, Titan was formed as a vehicle to provide short-term bridge loans to investors, primarily buying properties at auction. Titan was put in business with one investor who wrote a $4 million check and put us in business, and since then we've grown significantly in the short-term lending arena. And as a result of that, we've been able to make quite a few real estate notes available to investors, as well as an opportunity for capital investment. I myself am a veteran lender. I've been a lender here in town for 25 years, since 1989. It's hard to imagine it's been that long already. Titan sells the notes we originate. We also buy bulk notes and sell them individually. So we also have, with our partners, some of whom are here, we have a system set up to search out and find notes that we think meet our criteria and make those notes available. We buy them in bulk and we make them available to investors as well. So we're talking today about both the notes that Titan originates and has available, and notes that Titan has acquired and has available to investors. And let me see if I can get rid of that real quick. A little pop-up. Titan Capital Holdings is a licensed mortgage broker and direct lender in Arizona, Nevada, and California. So that's the basis of where our notes come from. Titan's mission is to open up the possibilities for investors to profit from real estate without buying it, selling it, or managing it. We came up with that slogan a little over a year ago, and we like it because that pertains to what we do. Some people like to be directly involved in the real estate. When you invest in our notes, it allows you to be involved in real estate without buying it, selling it, or managing it. What is a note? Simply put, a note is a promise to pay. It looks like our audience here has probably all borrowed money for a home loan or a car or something at some point in time, and the promise to pay is done in the form of a note. Well, our real estate transactions are the same. If you've ever written a check, or you've generated a note. That's simple. There are two types of notes. There are performing notes, and a performing note is where the payments are being made. That's really our focus. Our focus for Titan and what we're talking to you about today is performing notes, be it Titan performing notes or performing notes that we've acquired. A non-performing note is one where the payments are not being made and it's considered in default. There's a whole different strategy that's involved in buying non-performing notes. That is not our focus right now. Our focus is on issuing and providing performing notes or acquiring performing notes and then sharing those performing notes with other investors. On the non-performing side, they can be very complex. And if you haven't been well educated in that side of the note business, I'd recommend you stay away from it, or at least get yourself completely educated and up to speed in that area. Two types of performing notes. We're going to talk to you today about partial notes and whole notes. And somebody's ringing. We have pop-ups and phones. A partial note is where, and I'll show you that in illustration as we get a little further through this, but a partial note is where Titan's acquired a whole note, and we sell a partial or portion of that to the investor on a shorter term. Titan's behind the investor. We'll show you the illustration on that. It allows an investor to participate ahead of Titan in a more secured position, and the returns are different on the partial than they are on the whole notes, but the whole note is where an investor would fund the entire note. We'll walk you through both of those. There are 6 key factors in determining a note's value. And again, for our investors, for you and our audience and people online, we take responsibility for due diligence and our own level of reviewing of every note that we have, whether it's one that we funded or one that we bought. So there's a level of due diligence that we've already performed on every note that we have that we make available to our investors. These are key things that we go through. We provide all of our due diligence to our investors. So you see everything that we see in terms of what we've gone through to scrub a note, if you will. But we've narrowed it down to 6 key items that you really want to look for when you're looking at a note. The buyer or the borrower. Who are they? What's their situation? Is it a primary residence, second home, investment property? What kind of credit? What kind of work history? Things like that. The collateral. Probably one of the most significant items in buying a note is what's the collateral, because at the end of the day, if you're funding a note and a note goes bad, I'm sure all of you know that the end result is you're left with the collateral. Is the collateral something you can take back? Is it something that you can get sold easily? Is it a good piece of collateral in a decent area? Is the surrounding market supportive of your investment into that note? The down payment, otherwise known as skin in the game. What's the borrower have into the property? Obviously, the more money down, probably the more secure, right? And a borrower who's got significant down payment or skin in the game is going to be a strong borrower. The terms, our whole notes are short term. Our partial notes are longer term. That has to play into your investment strategy. But you want to look at the terms. The seasoning, is it a new note or has the note been around for a while? If it's been around for a while and has a good payment history, that tells you something too, right? And the paperwork, and again, we provide all the paperwork and documentation to our investors to see what kind of note they're getting into. The buyer, the borrower. I went into these a little bit on the previous slide, but the person making the payments is the largest factor influencing the value of the note. The type of the borrower, and we talked about this, is it owner-occupied? Is it a short-term fix and flip? Is it a buy and hold? Is it a rental property? What kind of credit do they have? The income, job, we touched on that a little bit. The collateral, and again, I talked about this a little bit, but the type of collateral. Is it a single-family home, 2, 3, or 4-plex? Is it small commercial? What kind of condition is it in? Again, if it's a fix and flip or rehab, what's the status of the rehab? For our in-house short-term bridge loans, many of our borrowers that are doing fix and flip, they will borrow our money after they've put down payment into it. So in other words, they'll put 20 or 30 or 40 or sometimes 50% down when they buy a property, borrow the balance from us, and then they'll go do their rehab out of pocket. Now, in our way of thinking, that even further enhances our equity position and the strength of the borrower on that note, right? Makes sense? The age, depending on where the asset is located. If you're here in Arizona or Nevada, those are going to typically be newer assets. If you're looking at notes in the Midwest or the East, or we were talking about Minnesota, certainly you could be looking at homes back there that are 100 years old. So what's the age and condition of the asset? That's something to take a look at. Intended use. What's the borrower's intention? Is it to keep it consistent with the current use or make changes? Again, these are just things that you'll look at in evaluating a note package to make an investment into. Down payment. Again, I touched on this a little bit, but otherwise known as skin in the game. The amount determines the LTV, or loan to value, on the note. The lower the better. If you're an investor in a note and you're at 50 or 60 or 65% on that loan to value, if you will, you're in pretty good shape, right? Because if that note goes south, you've got a pretty good solid equity position to be able to take that property back and put it back on the, go through the foreclosure process if you have to and get it back to market, okay? The down payment shows the borrower's commitment to the property. The more they have down, the harder it is to walk away. Always the case. Terms. What's the interest rate, otherwise referred to as the rate stated on an annualized return or yield on the investment? Rates will vary. On longer term products, those rates might be, the products that we're offering to our investors, those rates might be in the 7 to 9 range. On the longer term product, lower loan to value, and again, we've got an illustration here that I'll show you. On our shorter term loans, our 6, 12, 24-month product, those are going to be a little bit higher rate. Those are going to be in the 10% range because they're shorter term, okay? And you're taking a full note as opposed to a partial note. Amortization, otherwise referred to as the duration or length of the loan, typically stated in months. Some of this may seem basic to my audience here today, but we're trying to break it down because it is basic in terms of what we're looking at. Seasoning refers to the length of time you can see documented consistent payment history. Again, on some of our longer term notes that we're making available, some of them might be a year old, some of them might be 5 years old. What's the seasoning? What's the payment history of the borrower? The best scenario is no loan payments, no late payments or modifications. Although we see some of our longer term notes that do have late payments and modifications, especially with the real estate junk that everybody went through a few years ago, we may see some of that. The issue there is, how long's it been? If somebody had a modification or late payments 3 years ago, 4 years ago, 5 years ago, but since then everything's been made on a timely basis, is that a big deal? Probably not. What's the borrower's story? We put the borrower's story into every one of our note packages. Is it an investor? Is it owner-occupied? Is it an owner-occupied person that's gone through a bankruptcy? These are all different stories that might be related to the notes that we have available. Again, we talk about the paperwork. You want to make sure you see the note itself. You want to see the title policy on all the loans that we issue internally where we sell whole notes to our investors. We get title policies with what are referred to as 104.9 endorsements. That means that our title protection as the lender is conveyed to whoever the investor is that might acquire that note from us, okay? You want to make sure that the title policy transfers to you as the note investor. The same protections transfer to you, right? You want to, on a hazard insurance policy, we always make sure that hazard insurance is in place. We're listed as additional insured along with and/or assigns, which means any investor who steps into that becomes listed as additional insured as well. Those are probably, sorry about that. Not sure what that little dude is. By my way of thinking, from a true protection standpoint, you want to make sure the title policy is clean and is transferable to you as an investor. You want to make sure hazard insurance is in place. Doesn't do you any good to pick up a note on a property and have it burned to the ground the next day if nobody's protected. Little side story there, we've had it happen. We make sure that not a dollar leaves here without a hazard insurance policy in place, and we've had some that within the first few days of us funding on a short-term fix and flip type property, we get a call from the borrower, hey, half my property burnt down. The plumber was out there, his torch was going, he didn't see it start part of the house on fire, and goes back the next morning, half the house is burnt down. True story, not an exaggeration. So the good news is we were listed as additional insured, and the insurance check came to us, and we worked with the borrower on that to get all the work done the way it was supposed to be done. The disclosures, again, what are all the loan disclosures that were made to the borrower? What's the borrower's story? What's the payment history? We touched on that a little bit. How are you? Good. Welcome. I'm Adam Child. We're a little ways through it, but that's fine. and it's an open discussion, so, and I'm happy to revisit some of this with you too, so, but welcome. So partial notes, again, as I mentioned, we have partial notes and whole notes. So what's a partial note? We're able to offer partial notes due to our bulk buying power. So well, let me go through this so I don't overtalk myself here. Partial notes creates a safer investment for the investor. The investor is in first position. Titan's in second position, getting their return only after the investor is fully paid. I'll show you an illustration of that, but to try to just talk to it for a minute is we're able to buy notes in bulk, and we're able to buy them at a discount. So that's our incentive to do that. Now these might be 15, 20, 30-year notes, okay? And they might be at 4 to 6%. Well, we've created a formula that allows us to put an investor in first position ahead of us on a shorter term, right? And increase that yield to the investor. Then Titan is in second position. That's your security, because we're in all of our notes with our investors no matter what. We don't have any of our investors that buy, whether it's a whole note or a partial note. There's never a note that we put an investor in and say, see you later, because we're in the whole notes with our investors, and I'll show you that illustration, and we're in the partial notes with our investors. So last year we sold over 65 notes, and 65 notes with, I believe, about 47 investors. And so we're on every one of those notes with every one of those investors, and when they recycle, you know, our investors are typically looking for another note to get into, okay? So a partial note is just that. It's where an investor gets in partial first position, and I've got a graph that gives a better illustration of that. There it is. So here's an example of a partial note. Let's just say this note is $100,000, and it could have a varied rate of return. But let's say the rate of return on that is maybe, or let's say the interest rate on that note, for argument's sake, discussion's sake, is 5%. Well, that's not going to be very attractive to a typical note investor. So what we've done is create a structure where we've acquired the note at a discount. The discount becomes our return at the end when it pays off, okay? So we can bring an investor into the front, as an example, at $62,000, and because we do a smaller portion of that note and a shorter term, it creates a higher return to the investor. Make sense? So in this example, this might be a $100,000 note that Titan has. We're selling $62,000 of that to an investor, putting the investor in first position with the note, with the deed of trust, with full lien first position ahead of Titan, and the investor's getting the full payment on that note that the borrower's making, and that, on our current notes we have right now, that's typically about 8%, okay? Now, if it pays off earlier, it pays off earlier. If it runs the distance, you know, this is an example. If my eyes are working correctly, you could be on that for 10 years. But we kind of play out the rule of thumb, which is most homeowners are either moving, making some change, a lifestyle change, move up change, move down change, refinance, one thing or another, typically every 5 to 7 years. Yes, ma'am?
Are there prepayment penalties in?
There are not. None whatsoever. Yeah. And we like that. And I'll tell you, that's a philosophy of ours because, and the question is for the camera, are there any prepayment penalties? And the answer is no. And we like that. I'll tell you why I like it. I like borrowers to feel free to pay us off. And my rule of thumb is I love getting paid off because I can get paid off and I can always go find another note. So, but no prepayment penalties. So they could refinance, they could sell the home, they could move, one thing or another could happen, but if nothing changes, then that's an example of a note that you're on for approximately 10 years, $62,000, getting an 8% return with full monthly payments going to you, and the payments are being serviced by an account servicing company. So we do set up all account servicing with a third party. Were you asking yes, sir?
Typically on an example like this, how many points does the borrower pay?
It can vary. I don't have an exact answer for that because when they got the loan, I would go on a conventional basis. I'd go with the rule of thumb, which is typically around 2. Mm-hmm. I get the question. It can vary per loan, but if I just use the industry,
Based on qualification of the guy.
yeah, and the industry norm is going to be right around 2, 2.5. No, that's good. Good question. But partials is something that, you know, a lot of typical investors and consumers don't understand. We've spent months literally putting this program together. We're in first position for major banks and institutions that, you know, we've had to go through a whole qualifying process to put ourselves in a position to be able to acquire these, and now we can acquire them in bulk. And here's another thing that's our philosophy as well, is any note that we've acquired, if an investor doesn't get into it, we still have it. We still own it. So whether an investor gets into one of our notes or not, we already own it. And if we already own it, we'll live with it. So the question that should come up, and that does come up, is, well, why do you want to bring an investor in? Right? That makes sense? And Rosemary just did it. If we have this much capital to play with, and there's that many notes to invest in, well, we can get that much working, we can bring investors in, replenishes our capital, and we can keep plugging along. And you're exactly right, Rosemary, that's exactly what we do. So we have a significant capital base under management here right now we're pretty proud of. We've grown nicely in the last couple of years, but the product that's available to us just far exceeds what we have available. So we've come up with a formula to open it up to our investors. And, you know, as I say, 65 transactions and about 47 investors last year. And I like to do this, knock on wood. We've been doing our note programs now for 2 years, and we've been around since 2009, and the knock on wood is 100% success so far. We've had some late pays and some slow pays, but we've had 100% success. So I have to say that cautiously, because the reality is at some point in time something's going to go south. And for you, the investor, what you always want to ask yourself is, am I protected? If it goes south, you lose your payments and you have to foreclose. Is your capital protected? That's the thing that's the big plus about the real estate, is your dollars are secured against real estate. And as long as you've seen the collateral, you believe in the collateral, and you know your dollars are protected against a decent asset, if it goes non-performing, you know, to me that's the worst case scenario. You look like you might have another question. Your wheels are turning.
Performing and doing well, or are they late pays, or?
Everything that we're making available is all performing. So on our short-term, what I touched on a little bit just before you got here, is we have short-term whole notes that we originate in-house. Short-term bridge real estate loans, 6, 12, 24 months. And we bring investors into those whole notes. Then what you just got in on is our partial notes that we have available right now. And so just to spin around to that, our short-term notes are, we've done our full underwriting here, and there again are notes that we've funded. And if an investor doesn't come in and pick them up, we're fine, they're just on our books. And we have every level of confidence in them. On the partial notes that we make available, part of our team here, John and Terry, and we've got a couple other guys that we do an extensive due diligence, okay? Because as I mentioned, if we pick up a note, before we make it available to you on a partial, we've done all kinds of due diligence. The title report, the property valuation, no matter where it is, we'll find somebody in Florida or Illinois or Minnesota or wherever to go and do an inspection for us. In some cases, we may fly there ourselves, depending on the notes and that kind of thing. So we do extensive due diligence before we make the decision to bring it in-house. Yes, Dave?
In the event that you had to, or as the investor or as your company had to foreclose, who actually handles all that paperwork and pays whatever expenses are involved in doing the foreclosure?
And that's a great question, Dave. So the question is, what happens in the event of foreclosure? Well, as I'll illustrate when we get through this further, whether it's on the whole note, on our whole notes, we participate in the income with you. On the partial notes, we participate in the, if anybody knows how to get rid of that thing, I'm open. On the partial notes, we participate with you on the back side, which is when we get paid off. Our objective is to handle the foreclosure for any one of our investors where that happens. I've had one note buyer in the last 2 years that wanted to sign off that if the property went into foreclosure, he'd take it over. It's completely fine. Most of our investors are just investors. They want to buy the note, they get it, they like the return, they like the security, but they don't want to manage it. So we actually take care of late payments, we chase them down. Between ourselves and our account servicing, we chase down the late payments. And in the event of foreclosure, we'll handle that start to finish if our investors want us to, and most of them do. From the expense standpoint, on the whole notes, the expense is the investors on the whole notes. And it costs about $2,000 to go through the foreclosure process. We have our own attorney, who's our trustee, who will handle that for us. But it's about $2,000 and it goes to the investor. John, on the partials, who would bear the expense on a partial? The investor.
Except they have us as the expertise and experience
Got it.
to walk them all the way through and make sure that everything's going accordingly.
Okay. So good question, Dave, but in partial notes and whole notes, the investor bears the expense of the foreclosure process, $2,000, but we'll walk through that, we'll handle the whole thing for the investor. Yes, Rosemary?
So, actually, these notes are all backed up like agreement for sale. A deed of trust would not come into play for your redemption period or anything.
John, can you speak to that at all?
I mean, are these mortgages backed by trustees?
We're the, yeah, exactly.
Yes.
They are. So then when you went through the foreclosure, it would be the 91 days after such and such and such, right?
Yes.
Depending on the state. But Arizona, Nevada, California, yes. On our short-term notes, yes. Everything's a deed of trust. I had to pause for a minute to just clarify, but we looked at some land contracts and some different things, but we took a pass on that. So everything that we're bringing in right now is secured by a deed of trust.
But your full notes are not, right?
Full notes are deed of trust.
Oh, they are also?
Yes. Yes. Yes, Dave.
You can add penalties and fees onto the foreclosure if that's what you have to do.
Yes, exactly. And another good question. So in the event of foreclosure, there's late charges, there's default interest, and all those fees, all that gets conveyed to the borrower, if you will. So thank you for pointing that out. So in the event of foreclosure, yes, it's an expense to the investor. Titan will gladly take care of the whole thing start to finish. You know, we tell our investors, we'll handle everything cradle to grave. You make the investment, enjoy the return. When you get paid off, we'll talk about another one, okay? And if there's something, we'll handle it cradle to grave. Yes, John?
I know we're talking about foreclosure, and I just want to emphasize that is the very last resort we do. Before we even get to that level, we actually, through our service providers and our partners across the country, we actually approach the people, you know, what happened, did somebody die in the family, did they lose a job, and so do we need to do a modification on our side, doesn't affect the investor, just get it back and perform it again.
Right.
Try to find out what happened in the story. And then the worst case, last resort, then we do the foreclosure.
But does the borrower have the chance, no, not the borrower, does the investor have a chance to take it over if it goes into foreclosure and do a deed in lieu of foreclosure?
Well, you can do it, yeah,
If you
Yes.
went, you can do that.
Yeah.
absolutely. That would be
But John makes,
option before foreclosure.
yeah, and John makes a great point, and thank you for that, is that we're not in business really to foreclose, you know, the loan-to-own type scenario, and we're not buying notes to foreclose on them, so John makes a great point. Our objective is to see the notes perform, see the borrowers, you know, if there becomes a situation, work through it with them. On the Titan side of it, since 2009, we're now at about 375 loans, 6 defaults in total out of 375. 3 of those were by deed in lieu.
You've been in a better market too.
Sure, the last few years. Oh, yeah. But it's, yeah, and you do have to address that. I mean, we encourage all of our investors at the end of this, there's 2, and I'll get to the risks, but just because we're having the discussion now and it's a good one, there's really 2 risks, 2 key risks, and that is that, 1, that the investor stops paying, so the income stream stops, right? The borrower, thank you, Terry. The borrower stops paying, so the income stops. And then 2 is, if there's some kind of catastrophic event, the market crashes, right, like we all saw a few years ago, and all of a sudden, you know, there's a $100,000 note, maybe the property was worth 120, and it takes a 30%, 40% hit. So what you have to ask yourself is, you know, worst case scenario, I'm a finance guy, ASU finance grad, and I started my early career off on the investment side, you know, securities and things like that. Well, the one thing I know for sure is that you can have a stock that's $30 a share, and it can go to $5 or $2, and you can't do anything about it. The chances of a piece of real estate that's worth 120 going to 10,000 is pretty slim. Now, what we did just see is a $120,000 piece of real estate go to 60, but that's a lot better than going to 0. The other part of that is having just come off that catastrophic event, pretty unlikely we'll see that for a few years. I think we've got a little ways to go. So, but the foreclosure process, the expenses, the lost interest, the fees, things like that, if you're at $62,000, all that gets added on. And so if you go through the foreclosure process, your final tab when you get through foreclosure might be $68,000. And if nobody picks it up at auction, then it ends up back with you. And then it's yours to deal with from there. Yes, sir.
How long before you start the foreclosure process? I mean, for a certain period of time to work out and stuff.
On our, good question, and on our short-term notes, on our in-house short-term notes, 6, 12, 24 months, our borrowers are in default on 31 days. So on 32 days, we can start the foreclosure process. On these longer-term notes where you're going to be a partial investor, that's going to be a traditional 90-day, I believe it's 90-day before you can start the default. So, yeah, so it's going to be a 90-day, and then you start the process. And we're intent 6 month on non-payment for non-performing that has to go through the full foreclosure process. Correct. Good question, and that's exactly right. We had a short-term note. I mean, ideally, as John pointed out before, we're in there. I mean, first of all, we're talking with you as our investor and saying, what do you want to do? And then we're going to say, here's what we recommend. And then we're going to get in there and try to take some proactive steps and get with the borrower and say, what's going on? What can we do to help you? And either do a deed in lieu, which is the most beneficial for everybody. I mean, if you know it's going to go there, why not just do the deed in lieu? And we're not Chase or Wells Fargo or somebody like that that has all this deed in lieu criteria. Borrower comes to us and says, you know, my partner died, I've lost my job, whatever, deed in lieu. There's not a big complicated process for us to go through. Boom, boom, it's done. So, correct. Yeah, and you're exactly right, and that's part of the due diligence that we do prior to that, because, yeah, otherwise a deed in lieu with 3 other deeds behind you could cause problems. Then you might have to foreclose. Yep.
And these are first lien, one lien only notes?
One lien, first lien. Correct. Good questions. And a lot of our longer-term partial notes come in various states all across the country. By design, we are staying out of states that we know have a long, cumbersome foreclosure process. We don't want anything to do with them. And we don't want to be introducing our investors to that either. Our investors, we have a significant investor group that's joined us in the last couple of years, and we're continuing to grow that, which is why you folks are here and you folks are online. We're all about making sure our investors are taken care of and getting them through the process and having a note perform short-term or long-term, because those investors stay with us. That's what's important. So, does that make sense on the partial note side? Everybody good with that? The whole notes, an investor's in first position. An investor buys the entire note. Titan is bifurcated in the interest income, and I've got an illustration for that. It's a safer note due to Titan retaining an interest in the note. So let me go back to, on a partial, Titan's acquired the note at a discount. We bring the investor in first position at a lower amount on a shorter term, which allows the investor to get a higher return. All the payment goes to the investor, okay? And Titan is paid off on the back side, which is when we get the balance of our capital back plus whatever our discount was, okay? So that's where Titan has our skin in the game. That's why we're interested in that note performing with you all the way to the finish line, okay? The finish line in this case would be if it goes the full 10 years, you're paid off at 10 years, the balance is all Titan, okay? So that's not something we want to walk away from. We're not selling you a note and saying, hey, good luck, hope it works. We're selling you a note that we're in with you, whether it's short-term or long-term. We're in with you all the way to the finish line.
So on a partial, you're making your money off the discount in the front, right?
Not on the front, on the back. We bought it at a discount. We bring the investor in. Our return comes when it pays off.
Okay, sorry.
Yeah, good question. But on a partial, we get our income on the back. That's why we're very vested in making sure it performs, you're taken care of, and then whether it's a refinance, a sale, or it gets paid off, that's where we get taken care of. These are longer-term plays for us, okay? On the whole note, and I've got an illustration here, but let's say we issue a $70,000 short-term bridge loan, 6 or 12-month bridge loan on a $100,000 property. Our investors will come in and take the whole 70. But on our short-term loans like that, we're doing rates of 16 and 18%. So we pay the investor 10, and we make the other 6 or 8 minus the servicing fees. We cover all the expenses, okay? And so we're bifurcated on the income. On the partial note, we're long-term because we're getting our profit on the end. On the short-term note, you're buying the whole note, but we're sharing the income with you until it gets paid off. So either way, we're with our investors in either scenario, okay? Here's an illustration we put together on a whole note that I was just speaking to. I don't know if this is going to take me off camera, but home value of $100,000, whole note of $70,000. The equity position is the protection for the investor, and it could be a 12, 24-month type term. But that's just an example of the whole note. And then again, on the shorter term, our interest rate's 16, 18%. The investor makes 10, and Titan earns the difference. Because on our shorter term notes, we're higher rate, lower fee. Okay? Make sense? Any questions? I think for those of you online, there's a phone number there you can text if you have any questions, or again, I'll give you our contact information at the end here. The risks. This is the stuff that our attorneys tell us we have to put in there and talk about, but you have to talk about it as an investor. Every investment has risk. If you're buying a stock, depending on the history and the success of the company, what's the risk of the stock? It can go up, that's the reward. The risk is it can go all the way down. What's the risk on a note? There's a possibility of loss of income. Again, we spoke to that the borrower doesn't pay. And then what do? Well, the first step is we try to reach out and make it performing. Work with the borrower, deed in lieu, whatever we can do. And then there's a possibility of the loss of principal. So let's take a catastrophic event like we just had. Let's speak to this note. Here's a $100,000 property that has a $70,000 loan on it. We have a catastrophic event, and that $100,000 property becomes worth $50,000. That's the most you can get for it. What happened to your 70? You just lost 20. So realistic scenario in a catastrophic market. What you have to ask yourself, what I encourage my investors to ask themselves, whenever you look at one of our notes, partial or whole, is you have to evaluate yourself. I've got my own opinion. John has his opinion. Rick, you've got your opinion. You know, what do you think the market is out there right now here, Nevada, California, Florida, Ohio? You know, what do you think the market is? And if you're getting involved in a note on a particular property in a particular area, what's your assessment? And so we'll share with you our opinion, but that'll be our opinion. You need to have your opinion too. So, you know, worst case scenario, which is what a whole bunch of people just went through, is that $70,000 note just became worth 50. You just lost 20 grand.
Are the borrower, the person that borrowed on the note, the homeowner, are they paying PITI on all these notes?
Great question. On the partial long-term notes, yes, and it's being serviced by a third party. So payments go to a servicer, taxes and insurance are held, principal and interest goes to the investor. On our short-term notes, they're all interest only. Investor short-term interest only. A good question. So there are risks, but that's, you know, in real estate, that's what it really boils down to. Payments might not get made, and there could be a hit to the values. And as you look at a note, where do you think you sit in that note if something like this happens? Yes?
Of course, this isn't going to happen, but let's just say you're on a partial note. What happens if you go defunct?
If I do.
If your company does?
Actually, that's best case scenario for you. I mean, it doesn't, that's the good news for you is if we go defunct, it doesn't change anything. You have a note secured by a first lien position that the only, if we all disappear tomorrow, it doesn't matter because you still own that partial note.
Providing that value is still on that property.
Providing the value is still there. And again, remember though, that we don't buy a note that we won't sit on ourselves. I mean, if we have notes available, we have a huge list of notes available right now. If nobody buys them, they're ours. And we'll collect the payments every month, and we're happy to see them perform and pay off, and we'll go move through them. But even on our whole notes, Rosemary, if you buy a whole note and we go out of business, it doesn't change anything because
No, I know on that.
you've received it's the same, it's a good question, but it's the same results on the partial. The only one that you need to be concerned on, either on the whole note or the partial note, is the borrower. So all that happens on a whole note, if we go out of business, is there's a receiver who's collecting our bifurcated income somewhere. And chances are, on the partial notes, if we go out of business, there's going to be a receiver who's going to collect our backside on that too. But neither for a whole note or a partial note, that's a great question, but the investor doesn't change anything there at all. When I came over and joined Rick here in 2010, I came from 20 years on the conventional lending side, and with the changes in the marketplace, and I'd been doing private money and hard money loans since the early 90s, this is the space that I wanted to play in. And when I came over here, and I just lost my train of thought on that one. It's tough getting old. I'm turning 52 pretty soon. I had some good story I was going to tell there, but I don't know, hopefully it'll come back to me. How are you? Good. Hey, you made it for the wrap-up. No, I'm kidding. We're 2/3 of the way through. I'm Adam Child, President of Titan Capital. How are you? And you are? Scott. Welcome. There's some food out there, too. We'll have some for you afterwards. We're having some good discussion, and I can't believe I just had an epiphany and I lost that one. All right. I know. See, you're all trying to help remind me now. I don't know. No, it happened before you got here. I can't blame you. Yeah, I mean, I got out of the conventional space and wanted to get into this space, but I don't know. I had some story I was going to tell. I'm going to move on from that one. John, you can keep trying to feed me hints, though. Just to back up a little bit, and I'll be happy to get with you after, too. We've got a little ways to go. But we're an originator of short-term notes, and we also have longer-term notes that we sell partial interest in. And I'll be happy to talk with you more directly as we get through this. So hang around, and don't worry, just glad you're here. So, but we were talking about the risks, and that's it. I mean, it's, you know, where does that note sit within the marketplace and against the home that you're on? And we were talking about what happens if Titan steps out of the equation and the investor is left holding the note. Doesn't change anything. So, oh, okay, here it is. Yeah, I know. Don't anybody talk. When I came and joined Rick and we started growing the hard money side of it, I've got a couple of gentlemen who I've worked with for a long, long time who are 30-year veterans of hard money lending in town. And one of the gentlemen, you know, I reached out to him and I said, hey, what do we do to, you know, generate more capital and do things like this? And he goes, let me come over and set you up with my note program. So that's what got us started in the note programs, the whole notes for our short-term loans about 2 years ago now, year and a half, 2 years ago. So here's a 30-year veteran, and I guess he doesn't mind that I speak of him, but it's Mitch Medgovich at Cattleman's Mortgage. Mitch has been around for 30 years here in town. And the point, Cattleman's Mortgage and Mitch Medgovich, he and I have known each other for over 20 years. There's a couple of us out there. We're friendly competitors. We get together. We share ideas and stories, and you know, we're all comfortable in our own skin and that kind of thing. So Mitch came over a couple of years ago, got us set up internally on our note program. The point to that is, you know, I'm talking to Mitch about how to grow our investor base. Well, Mitch retired, and he shut down Cattleman's Mortgage. He did that this last year. So this rolls back to your question. And the question was, what happens if Titan goes out of business? Well, Mitch, as an example, retired and shut his business down. And he had, I think he said by the time he shut down, there was still $30 million worth of notes out on the streets with his investors doing these same short-term and some long-term type notes. Because time for him to retire. 30 years, he weathered the storm, and he's got his place up north and decided it was just time for him to retire. So he set us up with our note program. He started redirecting a lot of his investors over here, which we're very thankful for. But when you call Cattleman's Mortgage right now, it says, if you're an investor and you have a question about your loan, please call Security Title. So the point to that is that Mitch retired, his business is shut down in a good, healthy way. You were talking about what if we go out of business. It doesn't matter whether we go out of business or we shut down or we retire or anything happens. You as the investors own the note. secured by a deed of trust, in first position. All you care about is the payments getting made to the servicing company and payments coming out to you. Boy, that was a long way around my epiphany. So did that help? You know what? He still directs his investors over here regularly, and so it's a nice, friendly relationship. How do you mitigate the risks on a note? Okay, so whether it's the whole note or a partial, you buy the notes through a trusted source. You buy the notes from an experienced team. What kind of asset management team is there? What kind of pre-buy due diligence, post-buy due diligence, and borrower workout? A couple of my partners here, John and Terry, and we've got a team of six people that actually does all the work related to our notes, whether it's the long-term notes that we do partials on or the shorter-term notes that we do in-house and originate in-house. We have a team, and it's, obviously I think it's second to none, but we've got a process that we go through. And one of the stories I was telling Scott before you got here is every note that we have that we make available to investors is a note that we already have. So we've already done our due diligence. We've already gone through the process. We've already determined that it's a note that we want. And an earlier question was performing or non-performing. We're just after performing. We're just interested in originating performing, and we're just after performing. Yes, Dave?
The servicing company that you talked about who receives the payments and disperses the payment, are they an independent party, or does Titan own them or own most of them?
Another good question, and it's completely independent. Third-party servicer is completely independent. On our short-term notes, 6, 12, 24-month notes that we originate and underwrite in-house, all the servicing on those goes down to Security Title on Central. On our longer-term notes that we do partials, the servicing is Allied up in Spokane, and they will handle servicing from payments anywhere in the country. Yeah, so good question, thank you. So, but how do you mitigate the risks? And I'm just cycling around because you got in for a little later part of it, and I'll still go through it with you. But every note that we have, if somebody doesn't buy it, we'll sit on it. Why are we selling it? Why are we getting investors involved? Because we have this much capital and that much product to go after. So we've brought these notes in. We can bring investors in here, which can replenish our capital to go and keep moving on. Okay. The team, okay, the Titan players, myself and Rick. Our asset management team, John and Terry here, who I've introduced you to, and Ryan and Chris. And again, there's extensive due diligence. We had a conference call this morning before this seminar for you folks, and there was a number of assets available for us to look at right now again. And they look very good, but the way we left it off is here's what our price has to be and here's our due diligence. So here's assets that we started looking at last night and this morning on the longer term. It may take us a week or two to decide that we're going to buy those, okay? And all that due diligence that we go through, we're not going to miss a beat. If anything falls out of our box, we kick them to the curb, okay? And that's what the team does. But if we make the decision that they're good to go and we're going to buy them, then we buy them and we make them available to our investors.
You don't use appraisers on any of it, do you?
We use, on our in-house whole notes, short term, we do either BPOs, CMAs, we also do appraisals. Typically I may have a CMA and a BPO at least in file. I'm always interested in comps. And if we go 12 or 24 months, I'll typically have an appraisal. On our partial notes, we have a BPO on everything, and we get current BPOs on everything. And in some cases, we might have an appraisal, or are we going to have just BPOs on? Depends on the property? Okay. So, but we will have current BPOs on everything, and we always check comps, regardless of the marketplace, because we're all versed at that. And it really just boils down to the comps in the area, right, with every property. But we'll have, if the property warrants it, like we have a number of construction loans on our books right now. I'm an old construction guy from the mid-90s here when everything was under construction in town. I love the construction loans, and we're seeing a little bit of return to that right now. So for instance, on my construction notes that I have on my books right now, all those are done with appraisals, and they're all done on a subject-to basis, which means subject to completion. So, but good question. The team, the favorable tax treatment. I didn't know a few years ago, being an old finance guy, and a lot of our investors don't know, that you can direct your IRAs to purchase notes. Might seem like an obvious thing, but a lot of people don't know it. I didn't know it. And we get a lot of investors that go, wait, what? I can do what? And I had a gentleman in here about a year ago, and he had an IRA. He's an Intel guy here in town, and because we've been doing these seminars here for the last year or so, bringing investors in, introducing them to who we are and what we do. And I have an email from him that I still have. He sent it to me in January, and it showed the recap of his IRA last year. And he said, Adam, thank you so much. Thank you and your team. He goes, my IRA hasn't performed this well in 10 years. So how many people are sitting on either self-directed 401ks or self-directed IRAs? Maybe they've had a good run this year, but what's the last 10 years look like? Chances are you're not getting 8 to 10% year after year after year. And a lot of people don't know that they can self-direct their IRAs. Two companies locally that we work with on a regular basis, and it really doesn't matter to us, but we're comfortable recommending both of them, is Vantage and AccuPlan. Vantage and AccuPlan are both custodians that will help investors do self-directing on their IRA. There's others, Equity Trust.
That's where I just came from Genesis Financial in Scottsdale.
Oh, okay.
I continue to buy the self-directed 401ks.
There you go. So Genesis is a group that does self-directed? There you go. We have probably most of our note buyers in the last year have come from these two, but there's probably another 4 or 5 that we see come through. So our note packages have already been approved by IRA custodians, both our partials and our wholes. They're approved by IRA custodians, so that's great. So you're making the rounds today, getting all your info. But that's huge because, you know, a lot of people, IRAs are a big deal, and a lot of people don't know that they can self-direct them. Alternative investments. So we actually, everything that we do at Titan is considered an alternative investment because it's not a bond or a stock or something in conventional financing. We actually have 4 vehicles available for investors, and we can speak to any of them. We just like to make you aware of them. This seminar, this presentation is about our partial notes and our whole notes. We have 2 real estate funds. We have the Titan Capital Real Estate Fund, and we have the LPO1 fund. The Titan Capital Real Estate Fund is for investors that don't want to invest, that want to make the investment but don't want to be in and out of notes and don't want to worry about the payments and do all the rest of that stuff. We have a real estate fund that investors can go into. That real estate fund makes the short-term loans, the 6, 12, 24-month loans. That real estate fund also has the capital that reaches out and buys the notes. Okay? No, private. SEC registered. It's classified as a Reg D 506C. We are SEC registered, but it's considered a private offering alternative investment. The LPO1 fund is a real estate fund that provides short-term transactions to borrowers that are getting back on their feet. So it's typically, the LPO1 fund just holds real estate for 12, 24, 36 months, no longer than 36 months, and it provides the real estate for people who are recovering maybe from whatever happened in the marketplace. Maybe they had a foreclosure, bankruptcy, or whatever took place. Maybe they were a real estate market casualty and they're just getting back on their feet. LPO1, and there's a lot more to it, but will buy the property and work out a transition for that borrower to get back on their feet and become the owner of that property within a 1 to 3 year period of time. So the LPO1 fund is a real estate owned fund, and the Titan Capital Real Estate Fund is a fund that makes the real estate short-term loans and acquires the notes. So we have whole notes, short-term, 6, 12, 24 month, range from $20,000 to $500,000. We have partial notes, probably on the short side, 5 years, 5 years to 20 years, probably 5 years to 20 years. Our whole notes are 10%, 6, 12, 24 months. Our partial notes are going to be 7 to 9, just depending on how we structured. Each one is structured differently on that graph. And then the real estate funds pay 10%. Titan Capital Real Estate Fund pays 10%, and the LPO1 fund pays 8%. 10%, thank you. 10% on LPO1, 10% on Titan Capital, 7 to 9 on the partial notes, 10% on the whole notes. So it ranges right in there. Why 7 to 9 on the partial? Does that make sense to everybody? Because we put you in first position ahead of us, and it's based on the payment that's being made by the borrower. So it's a better security position, lower loan to value, just a stronger position. So, makes sense? Did somebody have a question? Why buy a note from Titan Capital Holdings? You're in control of your investment. Again, when you make a decision to buy a note, be it a partial or a whole note, you've had an opportunity to review what we call our investor review package, which is the due diligence. You can review the note, the deed of trust, the title insurance, the hazard insurance. You can review the asset, whether it's the BPO, the comps, the appraisal, whatever we have, and you can review the borrower information. So you're in control. People like owning the notes because you can drive by it, see it, kick it, smell it, take pictures of it. You own it. Yes, sir.
Can you sell your interest in the note?
No. But here's the alternative, though, that we provide. And it's only because remember, we're on the note with you, either one of them, whether it's a partial, we're on that with you, or if it's a whole note, we're on that with you. On a whole note, we share the income. On a partial note, we get our return on the backside when it pays off. In the alternative, what I would tell you is if you need to get out, let us know and we'll either take you out or we'll find somebody else to come in and take your place, just because we're still in it. So, but we've done that. We've had borrowers that have gotten on some of our 24-month notes, and I'll get a call 6 or 8 months into it and go, hey, Adam, I know you put me on that note. You know, my wife wants me to go do something over here. We're remodeling a house or something else has come up. Can you get me out of the note? Sure. And we just make it available to investors, and typically we'll get somebody to come in, take that person out, and you're bought out.
Is there a surrender fee at all?
We haven't come up with one yet. Now that you ask, we probably will. Rosemary just screwed it up for everybody. No, and I'll tell you why is because just like we don't put any prepayment penalties on our borrowers, I don't expect to have any surrender fees for our investors, because we want our borrowers to make payments and pay us off. We want our investors to enjoy the experience, and if you get paid off and need to go do something else, we want you to come back. And I want you to be that guy from Intel who sent me an email and said, thank you very much, keep up the good work, and I've never seen my IRA perform this well. And when this one pays off, please find me another. That's how we want our investors here. And fortunately, over the last couple of years, that's the investors that we've built our relationships with. So no, but we also, everybody has a need for cash at different points in time. Everybody needs to make a cash call. I get that. Everybody gets it. So we've just tried to make it easy for you to do that. If you've got 2 or 3 notes with us and you need a cash call, well, let's look at, are they about to pay off? Or what are the notes, and let's make them available to Rick, or let's make them available to John, and let's get somebody else to come in and take you out. That's the easiest way for us to do that. We just, because we're tied to them, we don't want them out circling around the marketplace. That makes sense? Immediate consistent cash flow. Again, our notes are performing. The checks start right away. And that's what most investors like. And if you're IRA directed, the check goes right to your IRA. The account servicer sends it straight to your IRA. Okay? IRA friendly, outstanding team. You know, I can keep bragging about ourselves, but you know, you get the idea. Mm-hmm.
Maybe you already answered this. Can I sell my position?
That's what this gentleman just asked.
I didn't hear his question.
That's okay. You just asked the same thing, and the answer is no. But from a liquidity standpoint, the real question, if you want to sell your position, it's because you want to get out. And if you want to get out, that's fine. I would say just let us know, and we'll take you out. We'll either take you out with our own cash, which we've done a number of times, and then we just take that note and make it available to somebody else. Or we'll bring an investor directly in to take you out. So that's how the liquidity part works in there. But remember, that's what I was speaking to a minute ago. Because we're tied to it, whether it's short-term or long-term, because we're tied to it, we don't want the notes rolling off to other people.
Want to sell the position to make a few bucks, you know, on a position, but no, you're not going to allow that, right?
Yeah, I think the only way that you would sell your position and make a few bucks would be to get a discount, which would have to come from us. And I have to check with John, but I don't think we're going to do that. No, because the long-term notes that we've acquired them at a discount, and that's our paydays at the end. Okay, so we have a very significant vested interest in those partial notes. You know, we put you in first position, give you that amount of investment, that amount of return, and then when you're done, then we're getting paid off, or if it pays off within a 5 to 7 year period of time, then we're receiving our profit at that time. Okay. Alternative investments available for qualified investors, short and long-term. We have short and long-term notes available that I've spoken to. The alternative investments are our funds. We've had a lot of our investors who have invested in notes, and after they've rolled in and out of a few notes, they roll over to our fund because they get it, they understand what we do. Our funds are very transparent for investors, and it just gives them an alternative place to put their capital. Okay. How do you get started? For those of you online, again, this is the important part. You can look at our note inventory, which we're updating on a regular basis on our website at notebuys.com. You can call me here at the office, and I'll either speak with you myself or direct you to one of our team members, 480-889-5558, or email us info@titancapitalholdings.com. So we're taping what we're doing, so I'm trying to speak to the audience here as well. And we had a pretty good group online. That wraps up the presentation. Are there any other questions? You guys have had good questions today. Dave, good questions? Nobody text us online? Then hopefully those of you online will give me a call. But Terry had it on silent. Sorry, folks. I'm going to go back to, if you guys don't mind, I'll talk for just another minute because you just joined us here. But I'm going to go back to, you heard me talk at the end here about partial notes and whole notes. And this is an illustration of a partial note that we do. So we buy a long-term note for $100,000 that might have 30 years left on it or 20 years left on it. And what we've done is, because some of the longer term notes, are you good? Thank you, Rick. And I guess I can, everybody good? Rosemary, you good?
I'm fine, yeah. Thank you very much.
Good, please do.
And I can
Grab a
check
sandwich.
the inventory if I go to that www.buy.
Yes, and actually we were just updating it today. What I'll do is I'll email it to you.
Okay, sounds good.
Because I've got you,
You got that down there, BUKEY?
yep,
It's the bottom last one.
Rosemary, yep, gotcha.
Okay?
Yep, thank you,
very
Rosemary.
much.
So,
Do you have the presentation available?
this one? Well, actually, this is going to be recorded, so I can send it to you. But, I mean, I can talk to you a minute about this if you want, but this is the partials which we're introducing now. These are what we're starting to buy in bulk and make available to investors. The long-term partials, though, might be at rates in the 4 to 6% range. And so what we've done is we've created a formula where we could bring, as an example, we could bring an investor into this at $62,000 for a shorter term, and it increases the return to the investor. So it can take a 5% long-term note, and by bringing an investor in on a partial, we can put you in first position ahead of us at $62,000, and you might get 8% on that as an example. It's a lower rate than the 10% whole note, but you're at a significantly lower loan to value, and you're in secured position ahead of us.
So how this works, it's just you basically have, like, you hold the note and then you bring an investor in. So like the partial note, are you talking just one person bringing in, or are you bringing in?
We're one person or entity per note, and the only reason for that is because if I put you and John on a note, it becomes a security, as you probably know. And we don't have our securities licenses to do it. We've talked about doing it, but we jump through enough hoops just having our lender's licenses. Getting our securities license is a whole different thing. But that's all that happens is if we put two individuals on a note like that, it becomes a security, and we have to have a license for that. Now, what you could do as an alternative is you can create an entity, and you can have 2 or 3 members of your entity, and your entity can buy the partial. That makes sense? So that's how you resolve that.